Do you know how you're going to protect yourself from inflation? Well, I do. Hopefully in this presentation I can give you some tips. So why would someone want to protect themselves from inflation? What are the benefits of it, and what are the actual risks of inflation you're protecting against? Alright, here's an example. Let's say this is you, this stick figure here. You have $100 in savings today. Your buying power with that $100 today is $100, let's say. So for every $1 you have, you can buy $1 of goods. Let's say you invest in a bond that gives you 1% compounded for the next 10 years. You're going to end up with $110 and about 50 cents. Then, going to your buying power, let's say your buying power is reduced by inflation by 2.5% per year, and that's compounded. You're going to end up with a buying power in 10 years of $85.97, even though the raw amount of money that you have has actually gone up by $10. Your buying power will have gone down by about 15. So that's the risk of inflation. Leaving your money in cash while receiving a lower than inflation return will leave you with less buying power than you started with. Alright, so what do I do? You may be asking yourself, what are the solutions to this problem of inflation? Especially with today's times where interest rates are so low, they're not even going to outpace inflation. What will you do? So one thing that you need is liquidity, and that is a difficult thing because sadly you need cash, US dollars usually, to pay for goods and services. You might want to pay for a movie ticket, you may want to pay for a vacation, a plumber, whatever. And for now you need to hold that cash or some other asset that is highly liquid. And until Bitcoin or gold coins takes off, you're going to be paying in US dollars. Or your other option is holding a highly liquid asset or investment. That means that you can turn that asset or investment into cash as needed. So let's say you have a government bond that is an investment, but you can transfer that investment into cash virtually on demand because of the high liquidity in the market. Something like a piece of real estate probably isn't going to give you that high liquidity. Something like a common stock on the stock exchange, like in the NASDAQ or the New York Stock Exchange, is going to be fairly liquid as well. Now here's our other concern. We need our assets to be a store of value. So that means it maintains or increases its buying power over time and it doesn't lose to inflation. So if we go back here, his 10-year bond that gives him 1% per year, that is not a good store of value because it does not beat the 2% inflation, the 2.5% inflation. And this is actually the target rate that the Federal Reserve has right now for inflation. So if you can't beat 2.5% on your investment of inflation, you are investing, and that's a bad place to have your money, relatively. So, stores of value, real estate, commodities, common stocks, cash, not so much. So let's look at some solutions. What are some solutions to this problem? US dollar or fiat currency. What that means is that the currency has no intrinsic value. And by intrinsic value, I mean you can't get anything inherent from that currency. So here we can look at this timeline of the US dollar, and we can see right in 1913 the Federal Reserve is created. Immediately from there, the buying power of a US dollar is cut in half. And that happens from the inflation of currency. That's actually what they want to do. This chart represents the Federal Reserve's goal. They want to reduce the amount of buying power you have over time. It's like a tax, essentially. They're taxing all cash that you possess at 2.5% per year. So here we see the this is a deflationary spike with the Great Depression. That means buying power actually increased. And then here we see Bretton Woods Agreement. That means the U.S. government is going off the gold standard, or they're not going off of the gold standard, but adjusting their currency to gold. That is when they went on the gold standard. Excuse me. So they went on the gold standard. You can see things were relatively flat. Then right around this time period in 1971, that's when the U.S. government officially went off the gold standard for good. So our currency is not pegged to any real asset. And we see here continuation of the devaluation of the currency, the dot-com bubble, 2008 financial crisis, and then today. So let's see, if you had $100 when the Federal Reserve was created in 1913, today, almost 100 years later, you are going to have less than $10. That's 1/10 of the buying power that's been taken from you by the expansion of the monetary base. So avoid US dollars and fiat currencies. Other currencies are nowhere near even as good as the US dollar. So the euro, the yen, the won, the ruble, whatever it is, it's not going to be a good store of value over time, especially after the coronavirus crisis, where the monetary base has been expanded by over 20% and it isn't slowing down. So common stocks. So this might be something you invest in on a stock exchange, NASDAQ, New York Stock Exchange. These are companies like you see here, like Apple, Google, Facebook, Amazon, PayPal, Adobe, IBM, whatever. Those are tech companies. Or it could be something like a General Electric, Boeing. Those are different companies. What are good common stocks to invest in if you're worried about inflation? You need to have a capital unintensive business or a business that doesn't require a lot of money to keep it going. So let's say one of the worst businesses in terms of capital intensity is the auto manufacturing. So if you're an auto manufacturer, you have to pay for the parts for the car, transportation of the car, selling the car, land to keep the car, and that requires a lot of resources and money, capital, to progress through the supply chain. And by the end of it, you have to reinvest a substantial amount of your profits that you make from any given car into the manufacture of the next car, which means that you're receiving a very low free cash flow, which is the amount of money that you can take out of the business in any given year. So that's a good company if you want to avoid inflation. Commodities, commodity-based companies like mining companies here we see. A gold miner, a silver miner, steel companies even, copper, oil. I know oil's been really hit hard lately and a lot of shale producers can't produce at this price, but over time this commodity will rise in value relative to the US dollar, and it probably will outpace inflation. So those types of companies are good. Companies that possess high pricing power. This one is a little bit more difficult to explain. This basically means if you're a company, you have very strong negotiating power. So that means you have a lot of leverage, so that you are able to sell whatever price you want. So your suppliers or the people you supply, the people you produce for, aren't able to negotiate your prices lower. You can pretty much set whatever price you want, and that is very powerful because you're going to be able to pace inflation or outpace inflation with your pricing power. Alright, so next, fixed income, which might be a bond, a note, whatever. Avoid this. Even the inflation protected ones might not protect you from asset price inflation. They only protect you from CPI inflation. So here's a graph of Treasury bill, which is a bond essentially, and the interest rate over time, and we can see that it lags the current inflation. So whatever the inflation is, the consumer price index is, it's lagging it. So it's actually a lagging indicator. So right now, I would say buying a bond is like buying a bond right now is buying a bond at this point. It's like buying a bond when it's at their worst value, and inflation is going to go up, the value of that bond is going to go down, and you might actually get a negative real return on that bond, which means you're losing to inflation and you're not making money in real terms. So that's not a safe place for money, even though it may be highly liquid. Okay, last category, commodities and real assets. These are what I would consider good. So this is something like gold, and here's a chart right here on gold. We have from 1980 all the way to 2020 with the money supply on the blue line, and on the red chart line we have the gold price. So as you can see, the gold price sticks relatively closely to the money supply, and if you were looking for a correlation, this would be a pretty good place to look. As the money supply increases, the price of gold increases along with it. And so that means that because the Federal Reserve has said that the money supply has increased 20% within a year, we're going to see a massive spike in the price of gold, and we already have, but I would anticipate we could end up going well past 20,000 per ounce. Other forms, commodities, not necessarily a commodity, but a real asset is real estate. So with real estate, you're going to be able to have a real asset that is scarce. So they're not making any more land, at least that I know of. So you're going to be able to have pricing power, and it's going to maintain its value. But the only downside with that is it's going to be fairly illiquid, which means you're going to have a hard time getting in and out of the market if you need cash. So I recommend having a mixture of as little US currency or fiat currency as you can, having a mixture of common stocks, avoiding fixed income, and having a good supply of real assets such as gold, real estate, oil, precious metals, whatever. Having this would complement each other, because these real assets are things that will maintain their value and be fairly illiquid, while common stocks will have unsure maintaining their value, but if you pick them well, you will do well. But they will also be highly liquid, so that's a benefit there. Thanks for watching. Tell me what you think. Tell me what you're invested in. Tell me where you keep your money. Thanks for watching.